Newsflash. We've been together for quite some time now, yet do we truly understand how money and banks work? I mean, yeah, we can invest and claim our dividends, we can buy our first house, or we can even solve the inflation rate. Yet it still puzzles us. How do these things make sense? How do they control us? And most importantly, what do they have over us that can even dictate our financial future? Hendrik Smith says, banks are to the economy what the heart is to the human body. They cycle necessary capital to the whole, and they are barely noticed until pressure, necessity, or crisis. Hey guys and gals, welcome to another episode of Financial Ventures. Welcome back, and we are excited to introduce you to monetary policy and the central bank. If you like the content, be sure to like the video, subscribe to our channel, and hit the notification bell for more informative financial videos. Remember, all you need is financial ventures in your life's adventure. In order for the government to keep the economy under control, they only have two ways: monetary policy and fiscal policy. And we will explore all the ins and outs of monetary policy in this video. When you say monetary policy, it only has two goals: keeping the inflation rate at bay and managing the level of employment in the country. And it's not a secret that the central bank regulates monetary policy. The central bank is also known as the Federal Reserve Bank in the United States. Okay, that's too long. We can just simply call them the Feds. So, what is a central bank, you might ask? The central bank makes sure that the quantity of money that circulates in the economy is in the right amount. This in return will determine the interest rates. Okay, let's take a notch back. Why is the interest rate so important anyway? Here's an easy explanation why. If you are saving money, you receive an interest rate from the bank. If you borrow money, you need to pay the interest. So in simpler terms, interest is the cost or the price of money. See, if interest rates are high, borrowing money is out of the question as they get too expensive. And notice why people prefer to leave their money in the bank just so it can earn interest. Now, conversely speaking, if interest rates are lower, money is cheaper and more affordable. People then tend to borrow more in order for them to purchase goods like their cars or their business capital. Sometimes they invest in their homes too. Interest rates, in general, can increase the economic activity of a country. The thing is, economic activity will only be a good thing if we have unemployment in the economy. But if the economy is almost at its full capacity, lower interest rates will only cause more inflation as more money is circulating to purchase a constant amount of goods and services. See the dilemma here? Central banks want to promote economic activity by lowering interest rates, but at the same time to keep inflation under control. In order for central banks to achieve their goals, they always make sure they determine the federal funds rate at its target rate. This will help the central bank control the money supply, as well as be the basis of the commercial banks when they lend money to each other. Before we dive deeper into what Federal Reserves do with their interest rates, let us make a comparison between a commercial bank and a central bank first. By now, we know that the central bank of a country is the only institution that is allowed to produce physical currency or paper money and coins. But bear in mind that at this moment, debt is also considered money. When you use your credit card, it is as powerful as purchasing a good or service using your dollar bills. This leads us to our point that commercial banks create money by issuing loans. The central bank can create as much physical currency they want as long as they need to, but commercial banks cannot do the same. They can only make money if people deposit their money or request loans. But hey, want to know a secret? There is a lesser physical currency in circulation right now, which enables commercial banks to create more money on their end. Yep, even if the central bank monopolizes the commercial banks are richer. Maintaining a stable money flow is important, and it can only be possible if they control interest rates. Which makes us come back to our point earlier. What does the Federal Reserve do, and how do they determine what interest rates suit best a country's economy at a given time? The central bank or the Federal Reserve have several tools to influence the economy, but they primarily focus on the federal funds rate. The federal funds rate is the rate that commercial banks use when they lend money to one another. Commercial banks are required to keep a reserve requirement set by the Feds. This is determined by the number of deposits that the customer places in the hands of the banks. Now, if one bank is short, they can lend from another bank just to meet the requirement. But changing the interest rate is not as easy as turning the knob. They work hard to meet their federal funds rate, and they engage in open market operations in doing so. Open market is where the Feds transact business in the bond market to buy and sell government securities. In enabling this move, there will be a change in supply and demand. Thus, changes in the interest rates may be possible and evident. Over time, the Fed's open market operations were with short-term government securities only, thus only affecting short-term interest rates. But as a result of the Great Recession, the Feds decided to up their monetary policy and started dealing with longer-term securities to influence longer-term interest rates. This is now what we know as quantitative easing, or QE. You want to see a cool ripple effect? An example of this is when the Feds reduce long-term rates, it also helps lower the mortgage interest rates. This could again stir economic activity when people will buy new homes or take out loans to start their business ventures, or even pilot a new company line. This will then generate more projects, thus leading these companies to hire more people. Again, inflation and employment rates were taken into consideration. To wrap things up, the central bank creates the money and gives it to commercial banks by buying assets such as bonds and mortgage-backed securities. That is how money ends up in the financial system. Now the real question is, what do commercial banks do with the money? They're supposed to lend this money to people so they can buy goods and services and simply jumpstart the economy. But that's not the case, guys and gals. Hold up, let us explain. Commercial banks prefer to keep the money as reserves, which is why we have asset price inflation, which means that bonds and stocks went up. And that will be for another discussion. We thank you so much for listening. Comment down your thoughts below and suggest what else you want us to talk about. Remember, it's better with financial ventures in your life's adventure.